two things that money is for. It's a medium of exchange, and it's a storehold of wealth.
Yes.
So money, so you could say something's a medium of exchange, and then you could say, is it a storehold of wealth? Okay. So and money is that vehicle that is those things and can be used to pay off your debt. So when you have a debt and you provide it, it pays off your debt. So that's that process. And what we have is, through history, there's been two types of money. Those that are claims on something of value, like the connection to gold or something.
That's right.
That would be, or they just are money without any connection. And then we have a system now, which is a fiat monetary system. So that's what money is. Then it will last as long as it's kept of value, and it works that way. So let's say central banks, when they get in the position of like they owe a lot of money, like we have in the case, it's increasingly the case, and they also are a bind, and they have the printing press to print the money and get out of that, and you have a lot of people might be in that position. Then you can print it, and then it could be devalued in there. And so history has shown, forget about today, every currency has either ended as being a currency or devalued as a currency over periods of time, long periods of time. So it evolves and it changes, but everybody needs that medium of exchange, and everybody needs that storehold of wealth, so it keeps changing what is money over a period of time.
Dalio might be right. We might be at the turning point of a new monetary system, one that is entirely based on digital coins. However, unlike the private digital money, like Bitcoin, this type of money is based on similar technology but centralized, hence its name of central bank digital currencies, or CBDCs. Are CBDCs the next step for the current fiat monetary system? If yes, what are the implications? To answer the first question, the answer seems to be yes. Just a few years ago, CBDCs were nothing but theory, an interesting concept. However, the quick adoption of private digital money, cryptocurrencies, have made governments aware of the monetary competition to the status quo. Digital currencies have been around since the 1980s. However, they became more popular in the aftermath of Bitcoin's launch in 2009. Today, there are thousands of digital currencies on the market. These are also known as cryptocurrencies. A defining feature of cryptocurrencies is their underlying technology, the blockchain ledger. Blockchains can be either decentralized or centralized. Most of the known cryptocurrencies today, Bitcoin, Ethereum, etc., tend to function on decentralized blockchain technology. This makes transfers and payments very difficult to trace because there is no single entity with full control. Government-issued digital currencies, CBDCs, on the other hand, will be controlled by a central bank and are likely to be easily trackable. They would have the same value as the local cash currency, but instead issued digitally with no physical form. Over the last 5 years, central banks across the world have poured massive resources into developing their own versions of digital money. The argument used by most policymakers to justify the coming change from the current fiat/credit monetary system to CBDCs is that the payment function of money, one of the three main functions outlined by Dalio earlier, is changing. More people use cards to pay for stuff than cash. Recently, the European Central Bank stated that payments have long been an underestimated aspect of the monetary system, running reliably in the background and allowing the smooth implementation of policies in other areas, which took the spotlight. But a burst of creative digital innovation is now breaking this perception. This is most visible in the area of retail payments. The digitalization of finance has broadened the available payment options. Fintech startups have emerged. Big techs have entered the payments market, capitalizing on the networks they operate. The crypto universe has boomed and burst. Indeed, the crypto universe has boomed and burst, and central banks are catching up. One need only to take a quick look at the website of the Bank of International Settlements, the world's central bank, to see the quick progress governments are making in catching up. The White House recently announced America's possibilities for a digital dollar. The announcement read that, if the US pursued a CBDC, there could be many possible benefits, such as facilitating efficient and low-cost transactions, fostering greater access to the financial system, boosting economic growth, and supporting the continued centrality of the US within the international financial system. However, a US CBDC could also introduce a variety of risks, as it might affect everything ranging from the stability of the financial system to the protection of sensitive data. This was in September 2022, a few months after Biden signed an executive order that is designed to accelerate the US on the path to a CBDC. Indeed, a growing number of countries across the world already have CBDCs, either to be rolled out or already rolled out. However, there is a dark side to central bank digital currencies. The first reason to concern is that the government will have full visibility over each transaction you make.
Why are they so driven to eliminate cash? What's they got to do with central bank digital currency? Well, now we get into the purpose of the central bank digital currency. And the metaphor I used is that if you want to slaughter pigs, you have to get all the pigs into a cattle chute and run them into the slaughterhouse and then slaughter them. You can't just let them, run around. You got to herd them up and get them into a cattle chute, or cows for that matter. And so if they want to slaughter savers and investors, they have to get you into a digital slaughterhouse. And that's what digital money is all about. If you can't have cash and you can only have the central bank digital currency, then everyone's got to have a digital account. And once they've got you in the system, of course, they know who you are because it's all digital and they keep the ledger, back to the ledger. What can they do? Well, they can impose negative interest rates. So you have $100,000 at 1% interest. You go away for a year, you come back, you should have $101,000. But with a negative interest rate of 1%, you go away, come back in a year, and you'd have $99,000. Well, cash is an easy way around that. At least you bury it in your backyard, but at least you'd have the $100,000, in my example, a year later. But with a digital account, they can actually take it out of your account. Number one. Number two, they can put a timestamp or an expiration date on your money and say, okay, here's your money that's in your account, but if you don't spend 10% of it in the next 30 days, we're going to impose a 2% penalty. We're going to take it away basically if you don't spend it. Oh, what does that do? It kind of forces you to spend it. Is that a kind of stimulus? Maybe, I'm not sure. These things don't usually work out as the eggheads plan, but the idea would be if we don't have enough what Keynes called aggregate demand, we'll force people to go buy stuff by telling them if you don't spend it, you lose it. Use it or lose it kind of thing.
Government control of how money is used is the first reason of concern surrounding CBDCs. There is, however, a deeper reason to be alarmed by this development. This has to do with how the economy actually works. The law that governs productivity and wealth distribution cannot be controlled by government intervention, but it can be distorted. Put it simply, the most productive of us should get more remunerated than the least productive. The issue is that as the population grew, there are many more unproductive people than productive ones. In every industry, the job in question is dominated by a small minority of strong producers that essentially carry on their backs most of the sector. This is explained by the Pareto distribution.
The fundamental underlying measure is human productivity. What you find is that a very tiny percentage of people produce almost all the output. It's called a Pareto distribution, P-A-R-E-T-O, and it was studied in detail in scientific productivity by someone named DeSola Price. It's a square root law, so here's the law fundamentally. If you look at the number of people who are in a given domain, who are producing in a given domain, the square root of the people produce half the product. So that means if you have 10 employees, 3 of them do half the work, but if you have 10,000 employees, 100 of them do half the work. Right, it's a very, very vicious statistic. And you won't learn about that in psychology for reasons I have no idea about, because you learn about the normal distribution and not the Pareto distribution. But Pareto distributions govern, for example, the distribution of money, which is why 1% of the people in the general population have the overwhelming amount of money, and 1/10 of that 1% has almost all of that, right? So I think it's like the richest 100 people in the world have as much money as the bottom 2.5 billion. And you think, well, that's a terrible thing, and perhaps it is, but what you have to understand is that that law governs the distribution of creative production across all creative domains, right? It's something like a natural law.
These are powerful words. If CBDCs put so much power in the hands of governments to control money distribution, how will the very fabric of any economy, that is, its productivity, survive? Are CBDCs just another nail in the dying global economy? Let us know your thoughts in the comments section below. As always, thank you for watching and subscribe for more content like this.